Welcome everyone. Today we will explore international financial management. We will learn how multinational companies manage finance across borders, handle foreign exchange risk, and make investment decisions in a global context. This knowledge is crucial for anyone who is looking to work in finance, corporate strategy, or international business. International financial management involves making financial decisions in a global context. It combines corporate finance, macroeconomies, and international trade. Key areas include exchange rate management, political and regulatory risk, and cross border operations. Understanding international financial management is essential for multinational companies to optimize global financial performance. Domestic finance deals with a single currency, a national market, and local risk. International finance is more complex. It involves multiple currencies, global markets, and additional risk like currency fluctuations, political changes, and cultural factors. Regulations vary across countries, and capital can move freely across borders, and adding another layer of complexity. Companies expand internationally to access new markets and customers. They gain resources and technology, diversify investments, benefits from tax and regulatory advantages, and enhance their global competitiveness. Example includes Apple sourcing components globally or Toyota diversify production across countries. IFM has five key functions. The first one is investment decisions, which means evaluating global projects. Second is financing, selecting sources of funds like equity or debt. The third is dividend repartition, managing profit transfer. Fourth one is working capital and liquidity management across currencies. The fifth one is risk management. Theories of exchange rate determination. Exchange rates are influenced by several theories. Purchasing power parity explain long-term price equalization. Interest rate parity links interest rate differences toward forward rates. The Fisher effect connects inflation and nominal interest rates, and the international Fisher effect predicts currency depreciation based on interest differentiation. PPP suggests that in the long run, identical goods should cost the same across countries after adjusting for exchange rates. Absolute PPP compares price directly while relative PPP adjusts for inflation differences. For example, if India's inflation is 6% and the US is 2%, the INR is expected to depreciate by roughly 4%. Interest rate parity states that forward exchange rates reflect the difference in interest rate between two countries. Covered IRP uses forward contracts to hedge FX risk, while uncovered IRP relies on expected future spot rates. This principle helps companies avoid arbitrage opportunities and plan international financing. Fisher effect. The Fisher effect explained that nominal interest rate equal the real interest rate plus expected inflation. When inflation rises, nominal rates increase to maintain real returns. Central banks use this relationship to adjust monetary policy and stabilize economies. The international Fisher effect combines Fisher theory with international currencies expectations. It predicts that a currency with higher interest rate will depreciate relative to a lower rate currency. For example, if India has an 8% interest rate and the US has 3%, the INR is expected to depreciate about 5%. Balance of payment. The BOP records a country's international transaction. The currency account, the current account covers trade and income inflows. The capital account covers transfer and asset, and the financial account covers investment and reserves. A surplus strengthens the currency while a deficit weakens it. Companies monitor BOP to anticipate currency movements. Exchange rate system. Countries manage currencies using fixed floating or managed float system. Fixed system peg the currency to another. Floating rates are market determined and managed floats involve central bank interventions. For example, the US uses a floating rate while China uses a managed float. Risk in IFM. There are three main risks in IFM. The first one is transaction risk, short-term FX exposure during operations. The second is translation risk, impact on consolidated financial statement. The third is economic risk, long-term effect of on competitiveness. Understanding these help MNCs develop hedging and risk management strategies. Hedging techniques. To reduce FX risk, companies use derivatives like forward contracts, future options, and safe. Forward contracts lock in rates for future transactions. Futures are standardized contracts. Options provide the right but not the obligation. And swap allow exchanging cash flow. Proper hedging protects profitability. The global financial system connect market, institution and governments. The IMF ensures monetary stability. The World Bank provides development financing and the BIS coordinates central banks. Market integration increases volatility but also improves access to capital worldwide. International capital budgeting. Capital budgeting for foreign projects involves estimating cash flow, converting them to home currency, adjusting the risk, and calculating NPV. For example, an Indian company investing in a US project must consider FX fluctuation and political risk in addition to project returns. Multinational corporations MNC manage finances across multiple countries. They centralize treasury operations, net cross-border funds, and comply with different tax and regulatory regimes. This requires strategic planning and sophisticated financial management. PPP, IRP, and IFE provide framework to forecast currency movements. PPP links inflation to exchange rates, IRP links interest rates to forward rates, and IFE link interest rate differentials to expected spot changes. Understanding these help in planning international investments. IFM bridges corporate finance and global strategy. Parity models aid in predicting exchange rates. Risk management is essential for MNCs to protect profitability. Monitoring BOP and parity conditions help make informed decisions in international finance. Thank you for learning with Learn Finance with Richa. Make sure to subscribe for more MBA BBA finance lectures and insight into capital markets. Keep exploring and applying these concepts to real world scenarios.